link, so you'll be able to watch it as a private video. So I'm just going to stop the transcription. Okay, that's fine. And then let's share the window. Okay, so in this unit, you probably have noticed in the previous years, in AQ 2016, the unit was split into two different units. First unit was advanced bookkeeping, and then the second unit is called FAPR, final account preparation. But now, instead of doing it as two separate units, AAT has decided to combine those together into one big unit. The unit is called Financial Accounting, Preparing Financial Statements. You probably have books from different publishers. You may have seen them. They're the biggest book for level 3. They are the biggest book for level 3, and they carry 40% of the overall weighting for your level 3 qualifications. And it comes with its pros and cons. This unit's solely for financial accounting. Obviously, you're going to be moving on from your bookkeeping units on your level 2. On your level 2, you had two bookkeeping units. What are those units? If you remember right, ITBK and POBC, means Introduction to Bookkeeping and Principle of Bookkeeping Control. What do you learn there? If you remember, if you guys done double entry bookkeeping, first time you heard about that, you learned about book of prime entries, you learned about trial balance, you learned about adjustments, you learned about errors, how to correct the errors, and then also you learned about journals on those two units. Every one of those units you learn from there, it is going to be cascaded together to make this new unit there. Now we're going to take a step up. We're going to move forward. We're going to do something more than what you have done. But please do not forget your level 2 fundamentals, because level 2 fundamentals it's still very important. I lost count of students who thought it's going to be exactly what do you call same, or is it going to be any difference? It is same. The basics are same. No changes whatsoever if you look at it. You need to know your double entry. So you may know your debits, your credits, you know your Alice's, you know your debt click, you know your pearls. Those are the easier method to remember your debits and credits. Okay, I have my own methods to teaching them as well. But most importantly, you need to identify how that's going to impact your double entry. One of them increase, the other one decrease. This one increase, this is also increase. So it has to be the right balance. Your trial balance, it's the evidence to it. If you had your right debits and credits, your trial balance are going to be what? They will be matching it without any problem. But this module, you're going to look at not just only the adjustments, how we're going to do the advanced options. For example, you're going to learn about depreciation. What is a depreciation? You heard about depreciation in many part of the things. Certain assets do not retain the value over the course of times. Certain assets may contain for longer period, certain for a shorter period, but there is only one asset appreciates. If you can remember which assets you may think you may have an appreciation, only the land. The land, if you have a property, the land it's the only asset which increases in value throughout the time. Everything else depreciates when it comes to business. When it comes to business, every other assets I'm going to talk about as a non-current assets. Non-current assets are your long-term assets. You expect to use that for a foreseeable future. So if I'm going to buy a car for the business purposes, I have to have an idea of how long I'm going to use that non-current assets for. Same as if I have to buy a machinery, I have to have a plan how many years I'm going to use that machinery. If I acquired a building, how many years I'm going to be based in that building. Those are the important things we may decide. And the depreciation is done different ways. How depreciation by straight line or diminishing value. We'll look into those later. This, what I'm doing now as a taster session, this is going to be for one of many. I'm hoping if this worked out well, I'm more than happy to come back to you guys and go through like small snippets of these kind of activities. Gives you some sort of a taste of one-to-one with myself, or if you may have with the tutor, which will help you to reinforce your learning. Whatever I'm going to do for you, this is not going to be successful without you putting the effort on. You also have to do your homework. You have to also due diligence, and also you have to keep challenging yourself. Remember, if you don't do these questions at home, you don't do the practice or in groups or in your study plan, whenever you're going to do your exam, you're not going to have the right way of approaching them. So when I do my YouTube channel, when I started it, I simply done that YouTube channel for one reason. Many places you learn about accounting, but they don't teach you how to do the exam. Doing an exam, it's a trial itself. Yeah, you guys probably know, you've done few exams yourself. It's not same way you learn the accounting, because you have to have a certain time frame. You have to do within that time frame. You have to recall certain information you may not be able to remember all the time. So many challenges you're going to be faced with. But FAPS units tops it all, because you have to have a vast amount of questions, in different units you have learned so far, but they all been truncated into 6 questions, just 6 questions. First three are obviously the advanced bookkeeping side of it, and last three questions is going to be on your final account preparation. So let's see quickly here how the breakdown looks like. The breakdown here it says there, what are the syllabuses covered by? This is just boring stuff. You probably know what is expected of you. But most importantly, if you notice that here, 40% which start from financial statement for sole traders and partnership, and then you have interpreting financial statement using profitability ratios, preparing accounting information from incomplete records. These are the ones for the final account preparation. The other 60% up to the produce and extend the trial balance are from your advanced bookkeeping unit, but they're both together, as I said to you before. Okay, so here now, if you notice, the exam is going to be 6 compulsory independent tasks, and you get 2.5 hours. That is 150 minutes. So by average, I will allow 1 hour 30 minutes for the advanced bookkeeping questions and 1 hour for my last 3 questions, which is final account preparation. So 30 minutes each question for the first 3 and 20 minutes each question for the last 3. That is my time apportionment. Make sure you use the whole of those hours. Okay, so obviously it's going to ask you like any questions and stuff like that way. So now you're going to look at the double entry bookkeeping. You've done your double entry already there. You know what is a double entry is. It is fine. I'm not going to be doing that bit alone. I'm going to go into select a particular part with the people finding it challenging. Okay, so I'm going to take this session to do most likely like a depreciation question. One depreciation side of it, I'm going to show you what is the depreciation is and how the depreciation works. And then also I will try to show you accruals and prepayments, which is the most tough out of all of those chapters within this unit. Depreciation is not bad, but when it comes to accruals and prepayments, that gives a lot of nightmares to the students. Okay, so here I'm just going to quickly check whether I can find the slide for that one. Bear with us, please. Okay, so let me go back here. Share window. Okay, so here, depreciation. We're going to talk about depreciation. We have the depreciation of non-current assets done a different way. What is the purpose of depreciation, how we account for depreciation, and how we use NCA, which is the non-current asset register. Accounting for depreciation, it's twofold. If you remember, when you're buying an asset, when you're acquiring an asset, that asset is bought for a particular price. That particular price has to be capitalized. What does it mean of capitalizing something? Means it has to be put on the books as a capital expenditure. But what type of expense could be a capital expenditure? That is down to the business to decide. So like, for example, I am buying a van. When I buy a motor van, the cost of the motor van, it's going to be capitalized. given we can claim the VAT back on it. So we're going to worry about only the net amount, not the VAT, because VAT is going to be claimed back. So if I say, if I buy a van for £20,000 plus VAT, £4,000 is going to be your VAT, which you can claim back. You pay the dealer £24,000, but in your books, the account will register only £20,000 for your non-current assets. £4,000 will go as a amount we paid VAT, which is going to be a rebate to you from HMRC. They can claim it back because it's yours used solely for the business purposes. But when it comes to it, certain other expenses can be capitalized. For example, I bought the van, but I have to make that van suitable for my work. So if I have to install some parts within the van, which makes it suitable for that business, and that can be capitalized as well. So if I'm going to install like ladders on the side of the van, because it's a builder, they need to have a ladder installed there. They have to have a tail lift installed there. Those things will be capitalized. So that means that will increase the value of the van in the books here. But if I have to put fuel in the van, is it going to increase the value of your book? No, it is not going to increase it because they are day-to-day expense. Same as a road tax. If you have to pay, a levy on the vehicle, that is going to be an expense which you cannot capitalize. Okay, and if you have certain what do you call other expenses, like you have to have a service, MOT, they don't go as a a capitalizing cost. But sometimes if you make a major repair, for example, if you have a smaller repair, that will be an expense. A major repair may allow you to recalculate the value of your vehicle. Because why? If you change the engine of the vehicle, what it does to your vehicle, because the vehicle depreciated in value, but if you put a new engine on it, it will increase the value again. Okay. So therefore, that expense could be capitalized, but the business will have a policy. The business will have a policy saying an expense which is bigger than this amount could be capitalized. Okay, so that is what we call accounting for depreciation, and those depreciation will be registered in non-current asset register. And what we do, those depreciation could be done two different ways. First one is straight line, and the second one is diminishing balance. Let's see the difference between them. Straight line is you allow a useful life period for that non-current asset. For example, if I buy a machinery, I'm going to use that for 10 years and I'm going to scrap it at the end of the 10 years because I'm not going to sell it because it is finished used. I'm not going to be bothered using anymore. So that means the value of your machinery, when I capitalize it at the start of the lifetime, it will be reduced by 10% every year. For example, I bought the machinery for £5,000. A straight line depreciation will make it, we lose £500 of the value every year of the product, the usage of it. So that means eventually by the end of the year, your asset now depreciated to zero. That means it has no more value. So we cannot keep in the books, it's gone. But how to account for it? That's why we're going to look at it. The accounting for it, every time we depreciate it, we don't reduce the value of that in the book. The book will still show you the machinery was bought for £5,000. But to counteract the depreciation, what we do, we create an account called accumulated depreciation. What does that accumulated depreciation does? It gives you a realistic book value of your asset. Like for example, on the first year, if I'm going to depreciate my asset, I have £5,000 book value for my asset. My accumulated depreciation account will have £500. But you remember in your debt click method or your Alice or Pearls, whichever it is, your asset is a debit account, isn't it? That means in your trial balance, it goes on the debit account. But after 1 year, it does not have the whole £5,000 value. So what we do, we put the accumulated depreciation on the opposite side of that one as a liability against the asset. That means it pegs the value back. So £500 is reduced. So they call it The difference between them is, what is that? Anyone remember that name of it? Carrying amount. We call it a carrying amount, means that is the realistic book value of your asset. So at the moment, if I'm going to look at it, in the book it says £5,000, but it also has accumulated depreciation of £500. We call the carrying amount for that asset, it will be £4,500, because that is what I expect to fetch in the market if I'm going to sell it this year. This is my expectation. Realistically, it doesn't always work like that way. Okay. So further, every year, that accumulation depreciation will increase and your carrying value of your asset decrease. But we only talked about a credit entry. So what is the debit entry when I'm going to depreciate something? We have to charge the loss of that value as an expense to the business. That loss of value is called depreciation. £500 debit, an expense to the business, and £500 credit will be accumulated depreciation. So if I'm looking at it here, here, depreciation charge will go as a debit entry, which will go in the statement of profit and loss because it's an expense. A credit entry will into accumulated depreciation account will go into the statement of financial position as a credit entry, which will go against your non-current assets value. So if I'm going to look at it any further off that one, this one will reduce the value of that non-current asset into what we call again a carrying value. Okay, so now for this one, let's look at an example. I found it in Osborne books. Okay, so let me just look at that one. Let me share that with you from Osborne's. It's not bad. Few of you guys are here. Thank you guys for coming in today, and I certainly appreciate that. And of course, it's something I can do to everybody interested in studying the level 3, which is a huge challenge itself. Let me just find the file quickly. Bear with us, please. Okay, I do find this. Okay, let's look at this example, which I found earlier, F11. Let me just share this file. Let me go to Teams again. Share, Windows, that question. So what you noticed here, it says that a car which cost £10,000 is being depreciated 25% per year using the diminishing method. So therefore, I cannot use the same method I used before. If I'm going to look at it in this scenario, the first thing we know though is diminishing method gives you an idea of what amount we have every year as a carrying balance. That carrying balance will be depreciated for the depreciation ratio. Like here, for example, on the first year, if I use the straight line method, for example, straight line method, I use 25% per year. That means in 4 years, that car will be depreciated to zero value. But as you know, we don't use the car for only 4 years. We use car for a longer period. Normally, you see the cars are used 20 years nowadays very easily. I have seen so many cars on the road there, it could be 20 years old. Okay. But in the businesses, they normally have about 10 years maximum. Okay. But if I use straight line method, the depreciation charge annually will be £2,500 because it's 25% every year. But when I use the diminishing based, on the first year, it's going to be £2,500 charge. On the second year, though, you have to think about how I'm going to calculate the depreciation. So for that one, I'm going to get my trusty old calculator out in the system here. Let me show that to you on Teams. Bear with us. Stop sharing. I'm going to share the desktop. Okay, so you see the screen now. So here, The first year, I'm going to charge £10,000, 25%. So the carrying value will be 75% of it, which is £7,500. Now, this is the amount we're going to depreciate on the second year. So here I'm going to multiply this by 25%. So 25%, enter. The second year's depreciation charge is going to be £1,875. So you may ask me, what will be the amount of depreciation charge is this? What will be the accumulated depreciation? On the first year, the accumulated depreciation was £2,500. On the second year, the accumulated depreciation will be the original depreciation charge plus the second year of depreciation charge, and that will give you a total value of £4,375. On this £4,775 means your carrying value for the third year, it's going to be even reduced more. So that means this one minus 10,000, the carrying value is going to be 5,625. So if I want to depreciate further, I have to use this amount and I have to depreciate a further 25%. So here multiply by 25%, and then third year the depreciation charge will be £1,406 and 25 pence. Can you notice that on the first method, on the straight line method, you lose £2,500 every year, but with the accumulated depreciation, it just increases the same amount. But with the the diminishing balance method, the depreciation itself reduces. It is diminishing. It does not have the same amount. Okay, so that is a good example to show you. So next one, for example, if you look at this question here, a machine cost £12,000 net of VAT is expected to last for 4 years. At the end of this time, it is estimated they will have a residual value of £500 net of VAT. What will be the annual depreciation charge for a VAT registered business uses the straight line depreciation? So can you remember when I said to you on the straight line depreciation, we always going to find out if we have whether scrap value or no scrap value. If there is no scrap value, it is easy because whole of that £12,000 will be depreciated. But now there is a scrap value. The depreciable value of that asset is going to be the difference between them two, which is 12,000 minus 500, which is 11,500. So if I'm going to bring my calculator back up again, the amount of 11,500 will be divided by 4, which gives you per annual depreciation charge of 2,875. The answer is C here. Okay. And then if you notice that here, one more question I'm going to show you. This is a new type of questions you come across in the exam. Instead of using time frame like 5 years or 6 years or anything like that way, they use the usage, means how many hours we are using the machine as the mode to find your depreciation. That means if I'm going to have a machinery, that machinery expect to work for 20,000 hours. If it's expected to work for 20,000 hours, what is the meaning of that one? 20,000 hours. At the end of it, I have to get rid of it. That means if you have a scrap value of £5,000, and it's also saying here in its third year, 4,800 pounds, hours of usage was recorded. What is the depreciation charge for the year 3? So what I need to do, I need to find the depreciable amount. So what is the depreciable amount here? £104,000 minus £5,000, which is £99,000. This is the amount I can depreciate per hour. Means if I'm planning to use that for 20,000 hours, per hour, I depreciate the value of the machinery by £4.95. That means every hour I use the machine, this machine loses £4.95 in its value. So if we use the machine for 4,800 hours on the third year, the total depreciation we can charge on that scenario is going to be, for example, multiply this 1 hour rate. Remember your OAR in your principle of costing unit, you used to divide the budgeted activity by the budgeted overhead by the activity level. Similar to this one, 4.95 multiply by 4,800 and 23,760. This is the charge of depreciation I'm going to charge toward that year. Okay, so there are many questions I like that way. And I'm going to go through this gain and loss and disposal on another session. Okay, guys. So I won't leave that for you to think about it. Okay, what we can do, and this is the one we'll be doing next time. Okay, so for the second part of it, I'm going to quickly go through accruals and prepayments, because as you said, we have an hour, we've done 30 minutes. Accruals and prepayments is a massive subject. It will take longer to teach it properly, but I can show you what is the fundamentals behind it. Okay, I also allow you some time, about 10 minutes, for a question. If you guys are okay, if you don't mind, of course I don't mind extending it for a few more minutes. I have not got a problem at all. So let me find out the slide for it and I'll share with you in a second. Okay, bear with us, please. So here, Teams again, let's share that with you. Okay, accruals and prepayments. So if you guys remember, when you learned about accounting, you come across certain underlying principles. You guys heard about the going concern principle. You heard about um, what is the other one again? The dual effect principle. You heard about separate entity principle. You know what is a separate entity is? The owner and the business are two different entities. They are not same for the purpose of accounting. They may be okay for general sense. For the purpose of accounting, they are two different things. Same as the going concern. What is the going concern? Going concern is I expect this business to operate for a foreseeable future. In that case, will you be able to apply this accounting methods for all those accounts? If you think if the business is either winding down or it's going to be closed down soon or it's going to be liquidated, we cannot follow this same accounting principles. Why? There are different process for those things. Those are done by the chartered accountants. We don't have to worry about it because we learn what is the standard accounting. Okay, but the most important part is accrual accounting. What is the accrual accounting? You know about accounting. What is the meaning of accrual accounting? If I'm going to say that bluntly, accrual accounting means you account for something when they occurred, not when they are paid. That means if I incur an expense, whether I paid for it or not, if it happened on that particular accounting period, it has to be accounted for it during that time. There is no way around it because we can't push that to the next section, means to the previous year or the next year. For example, a tenant gives me 3 months worth of rent in advance, but my accounting period finishes in 2 months. So that means one of that monthly rent, it's falling under the next period. Therefore, we have to account for that extra payment. We have to factor it into the next year. That means we need to remove that extra receipt from our this year's account. We will know about that bit later in detail. Same as if you receive bills from your utility companies, they normally send you the bills 3 months after you used it. They don't speculatively charge you that for a business I'm talking about. For the what do you call domestic usage is different. You sometimes do a direct debit, okay? But this time here, they may charge you at the end of the 3 months period, but when the bill came, your year is already finished. You're looking at it, some of that bill charge is for the previous accounting period. That means it should have been accounted for on the previous period. How I'm going to adjust for it? That's other things are under this particular accruals and prepayments. So let's see here a couple of sides here. The accruals concept dictates you do the accounting when it comes to when the transaction occurred, not when you paid. So it applies to expenses and income. But you have to remember they are stark opposite. If I accrue an expense, what happens there? If you imagine an expense accrued means I haven't paid for it. Simple as that. We owe the account, but we haven't paid for it. So the account has a debit balance, but only if you pay for it, you'll have a debit entry in the expense account, credit entry into the bank account. But since we haven't paid for it, where is the credit entry is going to go? That is why we create the accrued expenses account as a liability, because for that period, if I'm going to say that correctly, I haven't paid yet. I have incurred the expense, I haven't paid yet. If you haven't paid it, what is that going to be? Is it going to be a liability for you? Yes, of course. Imagine you bought goods from your supplier, you haven't paid yet, they will go in your payable ledger control account, which is a liability account. So the accrued expenses also had the same identity. Accrual account, when it comes to expense, is a liability. But how about accrued income? What is the meaning of accrued income? Somebody already paid, supposed to be paying you, but they haven't paid yet. Means they owe us money. They are same as your debtors, same as your receivable ledger control account. They bought the goods on credit on the receivable ledger control account. So your sales account will show you a credit entry. RLCA will be a debit entry. Similar to income account, when you receive an income, is a credit entry, bank account will be debit entry. But in this scenario, the person hasn't paid you. So an accrued income will become an asset. So you will have a debit balance on that one. So we'll see that how it works in a minute when I'm going to show you an example question. Okay. So here it gives you some sort of an understanding. I'm just going to show that on the screen a little bit. So when you go back and watch the video, you should be able to find out what is the meaning of it. Okay. So that's fine. So here, same as that. An expense, when it's going to be accruing it, we're going to debit the expense account and credit the accrued expenses account. Because if you notice, expenses will go in the profit and loss statement, accrued expenses will go as a current liability in the financial positions. Both of them cannot go in the same statement. Remember, when you do a debit and a credit entry, if you put them in the same statement, it cancel each other out. It makes no sense, isn't it? So therefore, one of them will go into your profit and loss statement. The other one will go into the financial position statement. So they're saying here will depend on the expense that the accrual related to, for example, rent, electricity, or gas. We'll see that later for a little bit more. Same as a prepaid expense, it's an opposite. If you prepay somebody like more than what they have owed, the extra money I paid for them will become an asset. For example, I have paid a worker who does the cleaning for the whole year contract. That means I paid them in advance for the whole year. £1,200 I paid for the whole year. £1,200. Every month is £100. Think like that way. We started that contract, say the financial year run from January to December. I started the contract with them in March. Okay. So we paid for March to December, January, February. So that means March to February, I have paid them. So if I'm looking at the timeline for that year, I should have only paid £1,000, not 1,200 I paid at the beginning of the year. So that means what is happening to that extra £200? That has to be taken away from that expense account. If you notice that here, look, that £1,200 was a full amount we paid, but on the expenses account, we'll credit it to remove that prepayment, and we will debit that as a prepaid expense account. That prepaid expense account will reflect the £200 asset I have in there. Why? It's an asset because they owe that back to us. If we say we don't want their service anymore, that client or the supplier is going to pay that money back. They owe us that money back. So therefore, it's become an asset for me. But it does not matter if you carried on with the contract for the next year, the prepaid expense will be paying the first 2 months of that year on that expense. We call that as a reversal. We will learn about that a little bit more in detail. Okay. So here, this is how the opening entries will be made. But don't worry about it. I'm going to show you how this works. The reversal is removing that prepayment or accrual from their relevant liability or asset account back into the expense or income account, because that means you cannot keep that forever in that asset account or liability account. Why? We only used it so we can close the account for the year. But when you start the new year, you don't need that anymore. You just have to bring that cost back to the current year. We'll see that how it works in a minute. Okay. So let me show you an example question. This is how I teach. I'll show you a couple of slides, and then what I'll do, I'll go to the questions and then I explain the questions. If you work with questions, this is how you make yourself better, because reading a whole book for the whole day like this one, just only going to put you into sleep. Just do not do too much reading with this. Do too much as many as questions you like. Okay, so let me just bring that question up from that practice paper I was doing earlier. Let me find out where it is. Okay, share, Windows, screen, no, this one. Yeah, accruals and prepayment. Okay, let's do a couple of questions from here. Okay, so here, for example, here, this is a really good question. You're looking at interest receivables for the year ended on 30th of June 2017. The cash book shows total receipt in the year of £917. Interest receivable for June of 81 is, receivable for June of £81 is received on 10th of July 2017. That means it was received after the year finish. If you notice that here, it ends on 30th of June. This was received after. So let me show you, this is a very simple account. If you notice this, if I'm going to talk about it, the money, it shows there, the total amount I received. So here, can I amend it? No, it doesn't let you do it. Let me see whether I can use, oh yeah, okay, annotate. I can do this one, absolutely. Okay, so here, let me see. It's going to be kind of a messy because I don't have a sensitive marker which I can use here. Can I use this one? It has to be, yeah, with my hand. Okay, so I'll undo this. Okay, so here, let's talk about it. What is this accrued income reversal of £90 in this account? What is the meaning of it? It says reversal. That means this income wasn't paid to you on time on the last year. Similar to what you have received this year, 10th of July, this was paid a time after. That means this £90 was supposed to be for the previous year. So this has to be accounted for on the last year account on the credit side of the the interest receivable account. So therefore, the accrued income account had a credit entry. Now, this accrued income account is being reversed, and the income is being put back in here. So this amount, it's not a problem. We're just going to keep that in mind. We will say here, what is this? Select laser pointer marker. Yeah, I cannot do a round. Okay, that's fine. So here I'm going to talk about the cash book shows the total receipt for the year of £917. So if I'm going to write an entry, cash book receipt is the debit entry into the cash book. Why? Money coming in. So in this scenario, the credit entry will go into the interest receivable account. Why? Interest receivable is in itself an income. Income accounts are credit. So here I'm going to say cash book. Sorry about the handwriting, because I have to use this option because I don't have a decent stylus I can use. £917 now. But they're saying here, interest receivable for June 81. So June, for the month June, of £81 received on 10th of July. That means if I have to account for it, it must show in that current year, because the year is June. It's ending on 30th of June. So this particular amount should be accounted for this financial period, even though I have received the money on 10th of July. So here what we'll do, we enter this here as accrued income. Accrued income. And this one will go here as £81. Now, when you're going to total this account, the total will come down to £998. £998. Balance carried down. How much is going to be? The difference between them is going to be 908. And balance brought down 908. This is on the 30th of June. But in my profit and loss statement, this is the amount I'm going to choose. Okay, so this is the amount. On what date will any adjustment you have entered above be reversed? So here, when I done this entry, this has to be reversed on the first day of next year. So that means, according to this, this will be done on 1st of July 2017 or X7 or whatever. It's going to be 2017. That is the closest year. Okay. So this is the time they will be reversed. Okay. So this is how the accounts will look like. Let me bring your spreadsheet up quickly to show you all of these entries adjacent to this one. Okay. So bear with us, please. Let me just get rid of this bit here. I'm going to stop annotate. So let me bring this up here. This way I can do that one here. That's fine. Let me show that to you how whole of this will look like if I'm going to do in a spreadsheet. If I'm going to do that on a spreadsheet, let me just redesign it quickly. It won't take long. So here, T account, top border. Urgent center. Hey, and then I'll do the left border. See how quickly make a T account in Excel. So here, these are the accounts we're going to deal with. Okay. So here, for example, I'm going to do this interest receivable account now. So I'm going to say interest receivables. Okay. So here we're going to say accrued income. £90. This is how it was there, isn't it? So let me check quickly. £90. And then here, this side, we're going to talk about cash book, £917. And then accrued income again. But here, I'm going to do R there, means that's a reversal. No, not that one. Okay, that's a reversal. And this one is £81. Okay, so here the total is going to be 998, and then here 998, and balance brought down will be the difference between them, £908. And here balance carried down will be BCD. Some of you say balance brought forward or balance carried forward. It's absolutely fine. Both of them are same, 908. Okay, so here, when you make this entry, the account called here, accrued income account, is created. What it does for you, it will become an asset, because this £81 we created here, we will say here interest receivable accounts, £81. This is what we do at the end of the year. That means on 30th of June, so here 30th of June 2017, this is what happens to this account. So at the end of that year, once we done it, this will go into statement of profit and loss. After that, this account is gone because it's been replaced comparing your profit and loss. But this one will go into your statement of financial position. What is your statement of financial position specialty? It is your assets and liabilities, which carries over every year. So that means this one will have no longer have a balance, but this one gets carried over to the next year. So when we start the new year, 1st of July 2017, this will have zero balance when I'm going to start this account again. Okay, so I'm going to say this. I'm just going to copy this. And I'm going to paste it here. So I'm going to just do what I done earlier. I'm just going to do this one. You know what? I don't have to do all of it. I just have to do this one. Yeah, I don't need this one. Okay, come on. Where are you? Okay, here you go. So on that time, this receivable account is starting with nothing. So what we need to do, we need to put this accrued income back into this account. So to do that one, what we'll do, we call that the reversal. That gets done on the 1st of the month, where we put all my accruals and prepayments back into their relevant income and expense account. So here, for example, this time, the reversal is going to be exactly like the whole amount of that accrued income. So we're going to say here interest received, and I'm going to say here reversal. Okay, so this is going to be the reversal account, entered £81, which will bring it to zero because it's a credit entry. In this time, interest received account will have accrued income in the brackets reversal. And this £81 will be bought here. So what is the balance of this account now? On the 1st is zero, but on the 30th of June, it was £81. And this one will go into my statement of financial position as a current asset. Means somebody owes you, the bank owes you that £81 interest for that particular period. I hope this made a little bit of a sense to you, because we will do some more like this bit later. I probably will schedule another session. You may be able to come and join and look into these kind of a particular questions here. Like this one, I am planning to do that on the next session as the first question. Okay, but it may be next week or week after. I'm just going to let you guys decide. I'm going to put the feelers out. Let me check quickly. Yeah, Emma's going to look into the the dates. Well, I'll speak to
Yeah.
her, and she's been, doing so much work on the background. Thanks, Emma. I certainly
Thank
appreciate
you. Thank you
you
so much
also
for
coming in. Yeah,
you. Yeah, and
yeah,
as I say, I'll speak to you and we'll get some feelers put out and see if anybody else wants to join us. That'd be brilliant. Thank you.
absolutely,
Thank you
absolutely.
everybody else for joining us today. Thank you.
Absolutely. Yeah. Anyone got a
Thank you.
questions for me to pose? I can give few more minutes. It's not a problem at all. If I think Emma's got a question. I know she already, licking her chops there now. Yeah.
Mine's taken it straight back to the ETB, and that's the problem. I'm struggling right back at the basics, but that's just because I've only just finished controls. So, and the
Yeah.
thing is, you said earlier about costings and everything like that, but where I'm only doing bookkeeping, of course, I haven't had to do costings. So
Yeah.
it's a massive jump, and everybody
Yeah.
said that to me. Going
Yeah.
from controls
Yeah.
straight into FAPS is massive.
Yeah, it is a huge leap, but it's doable. Put it this way, doing costing does help, but it's not going to be the stop, because normally costing is just a value add for you, because some people do costing because they want to take the management accounting pathway. But if you're on the financial accounting, if you wanted to be a bookkeeper, these units, what you have talked about, it's absolutely fine. And
Yeah,
you'll have a little bit more clarity with it when it comes to the ETB. ETB is all about adjustment. You're going to increase one of it, decrease something else, but it still should match your financial statements.
yeah. It's
And
going. It's sticking with that. It's sticking with
uh
that dead click, isn't it?
it
Keeping
will.
dead
It
click
is
as well.
dead click all the way. Put it that way. There's no
Yeah,
much there to talk about apart from dead click, because dead click, it will be your savior wherever you go when it comes to 203, which is a double entry accounting. Dead click, you can always keep like a board in front of you saying this is debit, this is increasing, this is credit, it's increasing. Or if it decreases on the opposite side, if you want to reduce a debit account, you have to be on the opposite side. Mostly when it comes to accruals and prepayments, the students get it wrong because of the reversals, because they don't understand the policy behind the reversal, which I showed now. Reversal is something we do at the start of the year. The adjustment we do at the end of the year. They conflate two together, and that is the main reason they get it kind of a confused. But
yeah.
next session, I'm pretty sure I will do extended trial balance after I done this one.
Thank you.
Hopefully, we'll do some more with this one. And
Thank you.
if you guys still have any questions anyone wants to pose, put it on the chat. I'm looking at the chat now. Let's see anyone has come back with anything. Yeah, I'm sorry about the last minute change to Teams, because I thought Google, it might be my savior, but for some reason, it led me down first. So yeah, let me check here. There are some chat there. Yeah, okay, yeah, some perfect. Yeah, I've seen some of the messages there as well. Absolutely. Thank you guys for joining anyway. And then obviously you've seen me in my YouTube channel. I have discussed some of the questions, but they are solely from the AAT exams. It's nothing to do with what I'm doing now, because this one it's bespoke, because I only use this material to teach, and I haven't had the clearance last year to do any teaching sessions. From this year onwards, I'm allowed to do it now, because for some reason they find it's okay. So yeah, it's a win-win for everybody.
Yeah, no, thank you. Honestly, thank you.
No
Been
problem
much
at all, guys. So
appreciated.
yeah, I hope you guys enjoyed it. So I will put the this video up online later on. Hopefully, I will send you the links once I uploaded it, because obviously it takes some time for me to reprocess this kind of things I don't want to even do. I want to hire somebody who can do that for me, but then I realized it's me. I'll do it better. So yeah, if it's anything else, pressing apart from that, guys, I will say, without further ado, thank you very much, and I'm looking forward to see you guys again in future sessions. Thank you for
Thank
joining.
you. Thanks, Mai. Thank
All
you.
the best, guys. Take care. Bye bye.
Bye.
Thank you very much, Mo. Thank you. Bye bye.